You're about to join Jerry Parker, Moritz Siebert, and Niels Kostrup Larsen on their raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor Podcast Series.
Jerry Parker, Moritz Siebert, and I, Niels Kostrup Larsen, are back with this week's edition of the Systematic Investor Series, which is our weekly ongoing raw exploration of the world of rule-based investing, and of course, where we also take some of your questions. But today we're going to deviate a bit from our usual format because we are delighted to be joined by a very special guest, namely the one and only Jesse Felder, whom I'm sure many of you already know from his excellent podcast and blog. So let me start by saying welcome to the show, Jesse. Great to have you. And as usual, great to have you, Jerry, in the morning and Moritz in the afternoon.
Good morning, good afternoon.
Now, I think it's fair to say that this week was focused on Brexit and the many votes that took place in the UK Parliament. And as we know today, the many times they managed to say no. But of course, this week was also the last week of March and therefore end of Q1. So a good time to take stock of how trend-based strategies did in a quarter where US stocks soared 13% and also where bonds did really well. So for a strategy that is often referred to as a crisis alpha strategy, it'll be interesting to see how we cope with a quarter that, didn't really possess any crisis. So with that in mind, Moritz, should we do the usual? Get to you first and see how it all panned out?
Sure, let's do the usual. So year to date, because it's the end of the quarter, year to date, and therefore quarter to date is minus 5%. But I had a very good month, 10% up, and a very good past week, 5% up. And, I can really keep that very short. It's been long the dollar, long the bonds. That's been the thing. And that's been making the money. All the other instruments in the portfolio, the equities, the energies, bit up and down, but no meaningful gains or losses. So the dollar and the bonds.
Sure. Well, on our side, I would say certainly some of the same things. Interestingly enough, the bonds did very well for us this week. But the big winner for the week was corn. Nice to see some of the commodities doing well. The month as well, very strong for us, double digit. So and the year looking pretty, or the quarter looking pretty strong as well. But of course, it was also a month, I would say, with some challenges, right? Let's not forget lean hogs up more than 50% in a month, where I think most trend followers were caught wrong-footed, being short from the sort of the prevailing trend going into March. So I think a good lesson for many investors about diversification, about risk management, about not trading too large in any one opportunity. But like you, Moritz, clearly a month that was helped by fixed income in particular, really strong there. But nice to be able to talk positively about performance for a change. What about you, Jerry? Single stocks, did they have a big impact on your side, which is of course different to what we do?
Definitely a good period for being mostly long single stocks and just a few shorts. I don't participate in the interest rates to the extent that you guys do. I have this phobia about getting long something that's close to negative or zero. So that looks like a mistake. But there's a lot of good things going on in the grains, as you said, weakness there. And once I got long the hogs, they kind of reversed and got run out of a little bit of my palladium this week. Sort of a thin market that is subject to, unfortunately, some major givebacks. But overall, a good month, and it is feeling a little bit better about the trend following these days.
Absolutely. But of course, it's not only trend following we're going to talk about today, because now we want to turn our attention to you, Jesse. I think actually I skipped over a little bit in my introduction, but it is really great to have you on the show today. And we very much look forward to diving into kind of your world and how you approach the current environment, and also how you look at the rules-based investing and so on and so forth. But I think before we dive into all of those details, maybe just to frame our conversation today, it's always good to kind of understand a bit about your background, how you got to where you are today, and perhaps also what influenced you along the way. So if you don't mind taking us back in time to start out with.
Yeah, sure. And I'd be happy to. I've been interested in finance and investing for a long time. When I was a kid, my dad got an Apple IIe computer, one of the first home computers you could get, and he got me this game called Millionaire, which is basically a stock market simulator. And you can look it up on YouTube. It's a horribly boring game. It's actually incredible how horrible this game is if you try and play it today. But you'd pick a couple stocks and then it would like crunch numbers for 20 minutes or something, and then spit out your hypothetical returns. And so I kind of got bored with that after time, and I started kind of paper trading. This was when I was maybe like 10 years old or something, and I would essentially pick stocks and look up the prices in Barron's on the weekend, and so I was interested in it from a young age. And when I graduated college, I went to work for Bear Stearns in Los Angeles, and ended up working for a guy there who was essentially running a hedge fund inside Bear. Later on, we ended up forming our own hedge fund in LA, and did that for a number of years. And I literally quit that at the peak of the dot-com mania and moved up here to Bend, Oregon, where I live now. And I've been essentially just managing my own money and writing about the markets since then. So I'm really kind of grounded in a fundamental kind of value investing approach. But I've recently, over the years, kind of tried to add other methodologies and things to help improve my timing. Obviously fundamentals are not a very good timing utility. And so I've added, some technical, some trend following, really kind of a momentum-based analysis to my process in recent years that I think has helped me avoid value traps and these kinds of things. But thanks for having me on the show. I'm excited to talk with you guys. Trend following is something that I was introduced to a number of years ago. That's why I had Jerry on my podcast, was really kind of understand his process. And so, I'm excited to do this.
Absolutely. It'll be fun. Moritz, do you want to kick off, or how do you want to do this?
Yeah, well, we can do it anyway. I think we're pretty flexible on that. As you say, it's raw. But so, Jesse, we're all trend following traders. And so you've just mentioned it. So how do you trade it? Do you apply it to the futures markets or cash equities? Do you use ETFs? Is it systematic? Maybe it would be great if you could give us some more background on how you integrate that into your investment process.
Yeah, sure. It's definitely not systematic. In fact, I am kind of not a huge fan of systematic value investing. I just think there's so many companies that appear good values, but for some reason or another they don't really work out well. So it's much more of kind of a Warren Buffett type of approach to individual equities. I want to find things that are cheap and undeservedly so. And the thing that I was introduced to early on in my career that I think is really one of the fundamental things, in addition to kind of the margin of safety concept: buy something below its intrinsic value and you reduce your risk and enhance your returns. But in addition to that, when I first was at Bear Stearns and at the hedge fund, my mentor there really introduced me to studying insider trading and looking at trying to find predictive insiders. And so guys who have a track record at buying their own stock or selling their own stock at the right time, because nobody knows more about what's going on at the companies than the top executives. And so for me, I want to find a situation with a stock that I think is really cheap, and then it's that idea or that thesis is being validated by significant insider buying. So you have the CEO, CFO, what have you. And kind of the way I define significant is these guys are spending, hopefully multiples of their annual salary in buying up their own shares. And so I remember reading Reminiscences of a Stock Operator, and Jesse Livermore in that says, whenever a stock is truly cheap, the top executives will never fail to try and take advantage of that by buying. And so, to me, following insider activity has been something that I've been doing for 20 plus years, and I think it makes a real big difference to the value approach.
Interesting, very interesting. So you're keeping track on how effective that is, as opposed to say buying based on rules and just momentum. So you're getting track on the extra kicker that you get by that, from that insider buying.
Absolutely. So, I mean, just for example, one of the most successful insiders I've ever seen, his name's Bill Stieritz. He's a billionaire. He was in a book called Outliers, which profiled, successful CEOs that kind of went against the grain. And so I think they highlighted his tenure at Ralston Purina, where, he was basically generated 20+% average annual returns for shareholders during that time frame. But I really noticed him in late 90s, early 2000 when he took over Ball Corp, which was a company that makes glass jars, aluminum cans. You couldn't probably find a more, anti-dot-com mania stock. Nobody wanted to own a glass jar maker during the dot-com mania, but
certainly not.
Yeah, he came in and bought about $40 or $50 million worth of his, worth of stock with his own money, and put in his whole management team. A lot of the people from Ralston Purina, and they all bought tons of stock with their own money. And, Ball Corp since then, it's from 2000 to, 2019 is up 40-fold. And so, he's a guy that I pay close attention to. He's now the executive chairman of Post, and, has been buying some Post stock over the past few years. And that's another one that's quadrupled in the last 3-4 years. And so, these are the types of things that I look for, that you have an executive with an amazing track record, and not just in running the company, but in, buying stock. And so to me, that really helps raise the batting average.
And where are you getting that information from? Is it internet? You're looking, you have special sources, or is there like a central kind of like platform where you find that info?
Yeah, there's actually a couple different websites I use. The first one, my friend Asif Surya, he's a guy from over in Eugene here in Oregon, who built a site called Inside Arbitrage, and his site's excellent. Another one that I've been using a lot lately is called Open Insider, because every time an insider trades, they have to disclose it within 48 hours or something. So it is also, on the SEC website there, but these other websites kind of consolidate the information, aggregate it, so it's a lot easier to digest than trying to filter through the SEC filings themselves.
Sure.
Jesse, maybe before Jerry, you jump in, we got a question from one of our listeners, a guy called Francois, who wrote in and said that not long ago, and I'm not entirely sure exactly what the timing is here, that you had kind of gone on record saying you think we're in the beginning of a bear market, or we are in a bear market, and he would love to hear sort of a little bit, if you could talk about kind of your current thinking, positioning, or approach to the markets right now. Maybe that's a good question to get in early, so that we kind of frame the conversation a bit before Jerry comes on with some of his thoughts.
Yeah, no, I do think we're in a major topping process. There are, so, and my positioning in regards to that is so I have these value ideas that I'm really bullish on, and I own them, and I don't allow my macro kind of concerns to get in the way of taking advantage of micro opportunities. I think that's a mistake that I've made in the past, and every time I find a good micro opportunity, it looks something along the lines of a Ball Corp, I'm not going to fail to try and take advantage of that. But the way I hedge against general market risk, which I'm worried about now, is I'll have some individual shorts, or I'll use kind of a tail hedging strategy with put options, or a variety of combination of the two. If I do short individual stocks, it's in very small size. I do have some individual stock shorts. But mainly my concerns, about the broader market are, it starts with fundamentals. When you look at the Buffett yardstick, which is essentially the value of the stock market relative to the size of the economy, we're at levels that have only been seen in 2000 and in 1929. And so, value from a valuation standpoint, 99% of the time stocks are cheaper than they are today, and that would suggest that a reversion in valuations could be, pretty painful, like kind of like the bear markets we've seen over the past 20 years. But I don't, like I said, I don't like valuation as a timing tool.
Right.
And so when you look at the things that are, are important, omens of an oncoming bear market, the two things that I would point to are, breadth, stock market breadth overall, and then also risk appetites. And so, breadth, in terms of breadth, one of the things I use is I look at the number of Hindenburg omens, and I've written about this on the blog over the past year. A Hindenburg omen is essentially a marker of increasing divergence or disparity in the underlying stocks in the market. So you have a strong market, all stocks should be powering the market higher, or the majority of stocks. For a Hindenburg omen to be triggered, you need to have a lot of stocks making new lows. In fact, it has to be, just about as many stocks making new lows as making new highs. And so that would not be a sign of a healthy market. And I don't use it as a crash indicator, as some do. To me, I want to see what when you see a large number of these omens triggered, that's a sign that the breadth in the market is significantly weakening. And that was, back last fall, before we had the fourth quarter sell-off, we had the greatest number of Hindenburg omens triggered on the NYSE and the NASDAQ over a 10-day period, over a 20-day period, in history, or at least in the last 50 years, the data that I was looking at. And so that was a huge sign to me that, and the only other times we've seen breadth warnings that significant are before, in 2007 and in early 2000, late 99. And so to me, that's a clear sign that breadth is really struggling. The market is really struggling to maintain its upward momentum. And then when you watch risk appetites shift, and I'm talking about, investor preferences for different sectors and those kinds of things. A healthy market, you should see, investor preference towards cyclicals, consumer discretionary, these types of things, towards junk bonds rather than treasuries. And so when you see risk appetites shift towards treasuries, away from corporate debt, you see towards staples and utilities, away from discretionary and these types of things, and cyclicals, to me, that's a sign that investors are starting to shun risk. And so when you see a very expensive stock market with significant signs of dispersion or waning breadth, and then shifting risk appetites, to me, those things all point towards bear market. And so those are things that I've been paying attention to. And that's really my main reasoning for saying I believe we're in the midst of a topping process for the broad stock market right now.
Jerry?
Yeah, so many good things to talk about. I would just say that I've seen it. I think it could get worse, as far as I could get further along. I'm not long that many stocks. I have a really diverse portfolio that doesn't really change a great deal. And I maybe 2 or 3 from each of the major S&P sectors. And so in 2013, I was long 90-some%, so the 2014 was very ugly. And but now I think it could get worse. And I think that's one of the problems with trying to figure out where the top is that we underestimate it when it's good or bad for us. So I think that I'm not fully long yet, if that means anything to you. So when I first started trading and getting involved with the markets, I read books and was very interested in Marty Zweig, who sounds sort of similar to what you were saying earlier, Jesse, which is looking at sentiment, looking at insiders, trying to combine that with trend and money management. And even with Richard Dennis, part of the whole turtle story that gets lost is all the stuff that we were taught to look at besides trend, which was things like sentiment and too many people being on one side of the trade, and sort of adding some sort of discretion, which was sort of not frowned upon at all. But now we've all sort of turned into these systematic, robotic type traders and not utilizing all these other good ideas as much anymore. And every now and then I read articles about the next phase. Trend following alone is not good enough now. What else is going to be added to the trend following? And a lot of it does remind me of sort of the sentiment and looking at big data and trying to come up with other ideas to add to the trend following. I don't know if you want to comment on that, but my real question is centers more around passive and your thoughts on passive indexing. And do you see passive as sort of as a systematic approach that might get overcrowded, just like maybe trend following is overcrowded.
Absolutely. I think for me, what was really appealing about trend following is one of the biggest mistakes I have made in my career is selling stocks way too soon. So leaving a ton of gains on the table, and it's always like, hey, if the trend is working, why not hold on to this thing, even if it doesn't look cheap anymore, even if it's fully valued. And so for me, that's one of the things that has been valuable about that for me is hang on to a position that's working. And don't just sell it because it's fully valued. But in terms of passive, I do think there's a couple, interesting points to be made about passive. One of the things I think most people are unaware of, and I think, I should qualify this by saying I really do think the push for investors moving towards kind of a low cost approach and diversifying against, helps them rectify a lot of the mistakes that they make in terms of, buying high, selling low, and overpaying, for products that are not always in their best interest. But one of the big problems I see with passive is, and I'll offer a better systematic approach to traditional indexes, is that I think a lot of people don't understand that in 2005 they changed the index methodology from just being cap weighted to being float adjusted cap weighted. And so what does this do? This basically says it basically systematically does the opposite of what I'm trying to do as an investor. I've found that some of the most successful companies in the market are these owner-operated companies. So I always use Intel as the best example. You look at Intel under Andy Grove's leadership, and you made 30% a year, something like that, for 20 years. Then Andy Grove retires in 2000 and sells all his stock, and Intel has gone nowhere for the last 20 years. You've literally made no money. You've actually still lost a little bit of money in Intel. And the way the index works is when Andy Grove owned a third of the shares, during that wonderful performance period, they would have to systematically underweight it because the float was too small. The float adjusted market cap was much smaller than the actual market cap, and so the index would systematically underweight it. As soon as Andy Grove sells all of his stock, raises the float, now passive owners are going to say, great, now we can buy a ton of Intel, right when Andy Grove is getting out. And to me, that's a really big problem with passive, in that we're going to systematically underweight these owner-operated companies, which are some of the best companies. At least the ownership is aligned with you. They're not just getting stock options that they want to try and cash out at some point. They are typically long-term owners and aligned with other shareholders when you're an owner-operator. And so to me, that's one problem that I think, passive, and what it's remarkable to me, and Steve Bregman really kind of drew my attention to this when I had him on my podcast, is that even though passive has changed their methodology, they still use the passive track record of a non-float adjusted weighting going back in time. And no other money manager is allowed to do this, right? You change your methodology, you have to demonstrate what that methodology did back in the past. Passive is not doing this. They're showing, this is what the S&P 500 did up to 2005 as a pure market cap. But today it's not. They're not using that methodology. So it's almost kind of. I've written it's almost kind of a bait and switch, where this track record is not representative of the way they're managing money today in the indexes. But then there's also this issue of crowding too. And Charlie Munger had something interesting to say about this a couple times. Warren Buffett's partner, where that if you take passive to the nth degree, where passive starts becoming bigger than active in the markets, well, it actually undermines its most basic assumption. So, passive is essentially relying on the fact that the markets, to a certain extent, are efficient, and they only get efficient because active investors are analyzing values and making buy and sell decisions based on their research. So, to the extent that active is marginalized, passive investing is now driving, prices in the markets. And so the basic assumption that the markets are efficient, the greater passive investing becomes more popular, the less that underlying thesis of passive is actually valid. And so those are important things I think, passive investors need to think about. There is a different way that Rob Arnott has come up with called, it's fundamental indexes. And I really like these, and I've written about them, for my newsletter customers for a while, because they basically just create indexes using a different methodology. Instead of weighting on market cap or float adjusted market cap, they weight company by their sales and by their net asset value and basically fundamental characteristics. So rather than having the most popular stock in the market by market cap be the largest weighting, the company that has the greatest amount of sales and the greatest amount of fundamental assets and those types of things becomes the largest weighting. And so where this becomes valuable is you avoid the most overvalued, owning too much of the most overvalued stocks at the peak of the market, which I think is is one of the true, I think, important factors in value investing, is that it prevents you from taking those big losses in a down cycle, at least usually kind of outperform in the down cycle by owning value. And so by using a fundamental index, I think it's just a better approach.
You mentioned float, and certainly as a trend follower, I'm not an expert by any means of the imagination, but it couldn't escape my own attention that, of course, with all these share buybacks in the last few years, the float seems to be getting smaller and smaller as well. How does that impact on this situation as well?
No, that's absolutely true. I mean, so it's interesting to me to hear some of the rationale, for passive investing is that, the stock market is shrinking. The number of public companies out there has been shrinking. And that was actually one of the fundamental, arguments for owning stocks leading up to the 1929 crash, was that there's a limited supply of equity. So you have to take advantage of getting in on it now, because it's only going to keep dwindling. Yeah. Well, I mean, so absolutely buybacks are doing that. And, it's interesting, Charlie Munger, I mentioned him a minute ago. He talked about this almost very similar dynamic during the, Nifty 50 stock craze in the 1960s, where I think it was one of the big Wall Street firms essentially created a fund to just buy those 50 stocks, and they only charged 25 basis points. It was essentially an index fund in the Nifty 50 stocks, the most popular 50 stocks in the market. And, he said because so much money flowed into this one strategy, this Nifty 50 strategy, the record kind of created itself for a time. It was kind of a self-fulfilling virtuous cycle of money flowing in, pushing the prices higher. And I think that's also what's going on in passive, is that money's just, flowing in, and literally the market is now just moving on flows. And so, money flows into passive, market rises, money starts flowing out. But buybacks are also obviously a big part of that. The problem with buybacks is they are so cyclical. I mean, companies buy the most amount of stock at the peak of the market, right, and then at the bottom of the market, there's no buyback activity because of financial stress and all these other things. And so it's it's a cyclical factor too that compounds or exacerbates the cycle.
Yeah, absolutely.
Would you say that the almost unprecedented interest rate situation we have complicates some of the historical accuracy of some of the valuation calculations these days?
Absolutely. I mean, it's been debunked so many times, this idea of the Fed model, which is you should essentially you could pay higher valuations for stocks when interest rates are low. That explains investor behavior. They certainly do that. There's certainly a reach for yield when interest rates go low. People move to dividend stocks. And to me, it's amazing to see the valuations of some of these things. McDonald's is one, for example, that trades. It's twice as expensive as it's ever been in company history, more than twice as expensive. And there's just Boeing is another one, that they're so kind of insanely expensive. And it's all, due to this reach for yield. But, there's Cliff Asness wrote probably the original kind of critique of this thesis of low interest rates allow me to pay more for equities in a paper called Fight the Fed Model. And basically he showed that when interest rates are low, earnings growth is also low, and so it doesn't justify paying a higher price. Essentially, if you think of a discounted cash flow model, you can lower your discount rate. But what investors are doing, they're lowering the discount rate, but they're not also lowering the earnings growth rate. And in a discounted cash flow model, if you lower both of those things together, the valuation of the company doesn't change at all. And so you should actually, what investors are technically doing is they're lowering the discount rate, but they're keeping their earnings growth rate high, which is a, just a classic fallacy that you're absolutely right. Low interest rates create that distortion. I do think we're kind of seeing a shift right now from this long-term disinflationary environment to a longer-term inflationary environment. But that's another topic we can get into if you like.
No, I would love to stay on
times.
that. Yeah. I mean, if you don't mind more, it's just me jumping in because you mentioned that, and I think that's something that is one of your big themes at the moment, Jesse. And I would love to know from your point of view. I mean, I'm sure many investors probably can't remember the last time we had, real inflation, so to speak. And I wonder whether you have some suggestions as to how this transition may affect, strategies, including momentum, trend following. I mean, and I guess also when you see big transitions, I imagine that asset allocation becomes really important. So, how do you think investors should be thinking about this? Should what you're seeing turn out to be true?
Yeah, and these are very long-term dynamics. To just be clear, this is not something that's inflation's not going to. I mean, we're late in the cycle too, so we could start seeing wage inflation pressures. But, I'm talking about, over the next probably 10, 20 years. I think we've seen this disinflationary environment that's been a product of really two factors. One is the baby boomers coming into the workforce was a huge influx of labor supply. We've seen, the downfall of unions and all these kinds of things, and the labor share of corporate profits all go way down because labor supply has gone up. At the same time, we saw this big push towards globalization, right? Where the offshoring of labor became very popular among corporate America too, helped them really boost their bottom line and save a ton of money on labor costs. So with the combination of this huge demographic force of labor supply plus the offshoring of labor, you had a huge influx of labor supply that was very, very beneficial to keeping those labor costs low. Now we're seeing the baby boomers retire, and the generations following are not nearly big enough to pick up the slack there. So labor supply is potentially becoming constrained there, and then we're now seeing a lot of political things going on that are shifting this idea of globalization to more of a deglobalization framework. We're seeing a lot of this idea of offshoring rather than paying, and the political spectrum, we're seeing a lot of people talk about minimum wage and all these kinds of things, and you need to really focus back on employees. That's going to raise costs and potentially create a new inflationary dynamic. I think the way that investors need to think about this is what's done really well during disinflation. It's been financial assets, right? Stocks and bonds. So bond interest rates have gone down. We've had this incredible bond bull market for 30 plus years. We've seen that benefit the stock market, right? Like I just said, following discount rates boosts, is kind of even though it shouldn't boost stock prices, it does because of the reach for yield. In an inflationary environment, financial assets typically struggle, and it's real assets that do really well. And if you look at the great asset allocators, whether it's David Swensen in the Yale Endowment or anybody else, they all have a significant allocation to real assets at all times. So I'm talking about commodities and tips and gold and these types of things, real estate. So I think that's important for investors to understand that, a lot of people just have this 60-40 portfolio, or maybe it's 70-30, 80-20 these days, where it's just stocks and bonds. Well, if you own only financial assets and we do go in an inflationary environment, that's going to be very painful. So having an allocation to real assets to some degree is important normally, but just as a diversification tool, but I think it'll be especially important if we do see a return to kind of an inflationary dynamic.
I agree. That sounds great. And you're talking about that. You can do that by being long gold, being long real estate. But we spoke about value at the beginning. There's also a point to be made about value in commodities or value in credit or value in the fixed income market. Is that something that you're looking at? Are you looking at value plays also in other asset classes, or is the value view constrained to the equity markets?
Oh no, I absolutely apply it to commodities and gold and these things, and there's a chart that's gone around, and you look at the ratio of real assets to financial assets, and real assets have almost never been cheaper in history than they are to financial assets today. And specifically, I'm actually been bullish on gold for the past couple of years. It's up 20% since 2015, but it still kind of seems like it's struggled. It's surprising to me that, gold and stocks have done almost, equally well over the past few years, and people don't realize that. People are still very bearish on gold and bullish on stocks. But to me, I look at, gold as the inverse of the dollar. And when you look at what drives the dollar over longer periods of time, it's essentially the federal deficit. When the deficit's narrowing, gold does poorly, or, the dollar does well and gold does poorly. When the deficit is widening, the dollar does poorly and gold does well. And that's, a pretty strong relationship over time. And so right now is one of the only times in history we've seen the federal deficit widening dramatically during an economic expansion. And so this tells me that if we do go into a recession, the deficit's, already over $1 trillion on an annualized rate. We're going to see a $2 trillion deficit plus. That's going to be very bearish for the dollar and very good for gold. And so for me, it's interesting to see that, gold still hasn't broken out. There's still a lot of negative sentiment towards it, even though the deficit is widening. And that's potentially very bearish for the dollar.
Right. So that's the inflation and the inflation hedging. There's also, when we speak about the tail, say, right, and I think some of that was maybe in the area of the passive discussions that you guys had just a few minutes ago with, passive to me is not only just the passive, ETF trackers, there's also the closet indexers, there's, the systematic guys, all of that creates flow-driven investments, to the one side, and then also, if there's a change in trend, then substantially to the other side, maybe creating volatilities that, we haven't seen in many, many years. So looking at that, there's, you hear people speaking about we need to have a tail hedge for that type of environment. And so my question here is, are you looking at the VIX index in any shape or form? Do you trade products linked to the VIX? Do you put anything in place to protect the left tail or not at all?
Yeah, and I think that's a great question. I think, that's something that also passive investors should be considering today. I mean, you buy insurance on your car, you buy insurance for your house, you buy life insurance. Buying insurance against your investments, it just makes sense. And, why wouldn't you do that if you insure everything else? And so there are simple tail hedging strategies. I don't trade the VIX per se. I think, in his book, Mark Spitznagel wrote a book, and I'm blanking on the title right now. It's a terrific read. But in it, he outlined a very simple tail hedging strategy, essentially of buying out of the money put options, and pretty far out of the money. I think like 30% below the current strike price. That are 2 months out, and just rolling those over every month. And you spend about 0.5% of your equity portfolio on those every month. And so if they expired worthless every single month when you rolled those things over, you'd lose 6% on your portfolio. But the only way that would happen, of course, right, is if the market went straight up like 30%. And so if you made 25% and you were fully hedged, you'd still feel pretty darn good about yourself, I think. And, if the market did go down 20, 30% or something, these put options would typically protect almost all your entire downside. And so to me, a strategy like that makes perfect sense for equity investors who don't want to get out of the market, but do want to have some type of tail hedge insurance.
Absolutely. So just for the benefit of the listeners, Mark Spitznagel, his firm is called Universal Investments, I think, and they're specialized in offering tail protection strategies on all sorts of equities portfolios, be that S&P linked or Eurostoxx or DAX linked, all of that. And I think they're in business for about 15 or maybe even close to 20 years, something like that. Pretty good track record also.
Yeah, and Nassim's Taleb's partner, is his partner there. And the book is actually The Tao of Capital, Austrian Investing in a Distorted World. It's a terrific read.
Great. Cool. Jerry, Niels?
Well, one of the things that frustrates us a little bit is the lack of love that we all feel from CTA trend following and diversification. And one of the things that trend following can add tremendously is putting things in a portfolio like gold and silver and uncorrelated markets, energy, crude, all the commodities, even though most of the analysis done by traditional investors would be, how did it work as a buy and hold? How was gold as a buy and hold? And so if it did well, I suppose it can be in the portfolio, whereas if you wrap trend following around it, everything could be in the portfolio because it's immune to how it worked as a buy and hold. And so does that pique your interest, or is that something that you could see as a value for your portfolios or for investors?
Absolutely. I mean, to me, I've heard trend following discussed as an asset class unto itself, and to me, that makes perfect sense because it's when you look at the returns of trend following, it's uncorrelated to anything else. And so I think and I think this makes sense for especially a lot of the big endowments and big asset allocators and those types of things. If you're looking at putting money in things and your options are little venture capital, a little private equity, a little public equity, some fixed income, maybe hedge funds, and or commodities and all these things, the different asset classes. I think it makes perfect sense, and I think a lot of those guys are probably doing it where they say, hey, we want a significant exposure to trend following as an asset class because it's an additional diversification tool from these other strategies.
Yeah, I just read an article this morning from, let's give them a plug, Think Newfound. And the title of the article is 2 Centuries of Momentum. And there is, quite a bit of evidence and academic research on momentum. And once again, it's a little frustrating to read about evidence-based investing, which is a little silly in the sense that who out there is not investing and touting their ideas that it's not based on evidence. But it seems that the more traditional crowd is really interested in evidence that continues to prove that owning the S&P is the way to go, and the other evidence, not so much. Not so interested in evidence that trend following and CTAs can add value. But so that's a little. Not a question, but I didn't know if you had any comment on that.
No, I do think, this whole idea of evidence-based investing, I really think it's probably not much more than a marketing ploy. I think, the idea of what represents evidence-based investing is very, very fuzzy. like you said, it's hard to wrap, to pin it down. And, to me, honestly, it just brings up this idea too. I mean, I think what a lot of the criticisms from those who call themselves evidence-based investors, they say, well, we are avoiding forecasting and these kinds of things. And I wrote a piece about this a few years ago. I personally believe everything is a forecast. You cannot avoid forecasting. We're all using different methodologies to try and forecast. But if you buy something, you're forecasting a higher price. If you don't buy it, you're forecasting a lower price. Simple as that. And so every decision that we make is a forecast. And so these people that are, I think this idea of criticizing forecasting is really just, trying to differentiate their version of forecasting from everybody else's. And so that was kind of my point in the post that I wrote is we're all forecasting. So why don't you just tell me why you believe your version of forecasting is better than anyone else's? And really that's the discussion that needs to be had is what is evidence-based investing and why is it better than trend following or this have you, or what are the pros and cons, rather than just saying, we don't forecast, we're right. You forecast, you're an idiot. It's a marketing ploy.
Yeah, it's marketing, and they like their evidence. I mean, I'm in love with my evidence, but other people's evidence, not so much. I went to a evidence-based investing conference once, and Meb Faber was on this stage, and he said basically, and he said it recently on this podcast, that his analysis shows that historically, investors should allocate 50% of their portfolio to CTAs. And, as an evidence-based conference, if I had been running this conference, I would have had to stop right there and say, wait a second, this is either the biggest outrage ever, or we have new evidence. But of course, it went on, and not a word was said after that. But yeah, it is a little frustrating to have to deal with, pretending that everyone is open-minded to different pieces of evidence that don't really fit with their business model.
Well, to me, that's one of the most difficult parts about managing money. And it's why I really don't do it anymore, because I think it's so difficult to get people to do the right thing at the right time, right? Everybody wants to be passive today, and it's probably the worst time, I think, to be a passive investor. A passive buy and hold investor over the next 10 years might, prove to be one of the worst strategies you could choose. But that's just how investor, psychology works. They want to, think about how much money flowed into, tail hedging and all those kinds of things and short only funds in 2009-10, when it was the absolute wrong time to be doing that. Those guys were trying to raise money in 2006-7, when it would have been a wonderful time to allocate to long, short only, tail hedging, and they couldn't raise money to save their lives. And so, it's very, very difficult to, for this reason, I'm very bullish on trend following for one of the reasons that it's generally struggled in recent years. And I do think it's because we're in these transition points in a lot of these markets. We're in major long-term trend shifts, potentially from, bond bull market to bond bear market. And I've been bullish on bonds short term, but I'm talking longer term. And same thing in stocks. If we're potentially going into a more difficult phase, this makes it difficult to try and catch the trends, because there really just aren't big trends right now. But we potentially could see some really strong trends over the next 5-10 years that trend following will be able to capture either side of that trend, and passive will not. And so to me, that's just comes back to contrarian. Whatever's the most popular, strategy of the day is usually not going to be, do so well over a longer period of time.
And if I could just ask say one more thing. I love this idea about forecasting, and everything is a forecast. And we sort of try to say that's not true about us. And so we're buying these breakouts, we're selling these breakouts, and we're not doing anything. And so maybe, since we do have a 40% win rate, maybe we could compromise and say, okay, we'll go with you that we too are forecasting, but we're the worst people on the planet since we lose 60% of the time.
Well, I do think trend following is a forecasting tool. I think it's probably one of the more successful ones. And this is why I teach some investing classes here in Bend, through the community college. They're open to investors. And it's one of the main things I teach people, because it's really hard for people to learn how to be a good value investor. It takes a ton of work. You have to do a ton of research into financial statements and, the business model, listening to the conference calls. And most people don't have the time and energy to do that. And so I say, great, trade individual stocks, but just make sure you pay attention to the trend, whether it's just the 200-day or the 50 and the 200, the cross. This is why I really loved having you on my podcast, Jerry, because I think, if it's good enough for you and it's good enough for Paul Tudor Jones and, then it's good enough for individual investors. And, I do think, compared to all the possible methodologies an individual investor might use to try and time an individual stock, trend following is by far got to be, the best, or, one of the top ones that an individual investor can utilize.
It's funny when I hear that conversation between you and Jerry, Jesse, because I feel the same when we come out and we say we're trend followers, and people say, oh, well, I don't believe in trend following, and et cetera, et cetera. But you could argue that most investors really deep down are trend followers because they buy something because they expect it to move to a higher price, or they sell something because they expect to move to a lower price, even though they won't confess to themselves or they don't think about themselves as being trend followers. But that's in reality what most investors do.
And they do it much more poorly than they otherwise would do if they were pure trend followers. I mean, right? They typically buy, when they wait until it's late in the trend, right? So I would say they're more momentum based investors than trend. But what they're typically trying to do is catch the trend. So why not use a trend following approach?
Yeah, absolutely. Now, I promised also to bring in some more questions from the listeners, and one of our favorite listeners, George, sent in a question, and I'm going to start by reading a quote that he, I think, comes from you, Jesse, where he says, "I spend a good portion of every day reading through a wide variety of publications, blogs, research reports, and other sources in an attempt to understand what the consensus is towards any given asset class or security, and how it may be evolving. To me, this is crucial in discovering those investment opportunities that everyone will inevitably agree with later." So his question goes on to say, can you talk about why you feel knowing what is happening is better than just responding to price like trend followers?
Absolutely. I believe that what drives non-trend followers, and non-trend followers dominate the market, is narrative. What is the narrative in the market?
Right.
And narratives go from, a beginning state of, disbelief. People, ignore, the news. They ignore the evidence in front of them, to a state of acceptance, to a state of full embrace, where you get the full euphoria towards a trend. And so to me, when you can start paying attention to, okay, where are we in that narrative cycle? Have people started embracing this? Are they, have they completely embraced? And so, passive investing might be a good example, right? So, for a long time, nobody wanted to own passive. They wanted to try and beat the markets by owning active. And then more and more people started realizing, okay, you know what? We're not doing so well with the active stuff. Why don't we just go passive? And now I believe we're in the stage of a passive mania, where people literally can't even hear the criticisms against passive. And to me, this idea that passive, the popularity of passive has now undermined its most basic thesis is so plainly evident that it should be, I guess, convince people that they shouldn't be doing, passive, or they should be protecting themselves in some way against the risks that they're creating. And so to me, paying attention to these narratives is very important. And obviously that's a big macro narrative. But I want to look at them on all types of scales and in different asset classes. And so this inflation idea is one of those narratives that I'm paying attention to now, which is you see the popularity of modern monetary theory, something like that, right? And you could never have this idea of we can print and spend as much as we want without any consequences. You'd never have this idea unless you're at the very, very end of a disinflationary framework that has gone so far that everybody is convinced inflation can never come back again. And so, I think it's very valuable to pay attention to those things, because you just kind of take the temperature, the market's temperature, in a bunch of different ways, in a bunch of different areas, and it's valuable in terms of understanding where we might be going.
So it's more like a contrary indicator for you, in a sense, because the narrative will usually be way too late to really, before the whole world picks up on, well, maybe passive wasn't that a good idea. The market's most likely already going to be down by quite a bit, right?
Right. The markets, and this is interesting to me too, that, a lot of the times people hear me talk about this stuff and they go, Jesse, these are such long-term dynamics, right? That's not going to matter for years. And I say, well, the market is a discounting mechanism. And there's a reason why Stan Druckenmiller says, if you invest in the present, you're going to get run over. You have to invest in what's the market going to look like 18 to 24 months from now. And so paying attention to these narratives is really what points you in that direction of what's the market going to look like in 18 to 24 months. If you pay very close attention to, these trends, and essentially these are, I'm trying to trend follow, but in narrative terms, not in price terms. And so
how does that work in practice? Actually, that's interesting. I mean, how so I understand about the narrative. I think that makes sense. But then when it comes to the timing of it, I mean, what tools would you kind of use to get the timing right?
So I guess probably, I mentioned Bill Stieritz earlier on. I started looking at Herbalife stock when Bill Stieritz got, bought $100 million or something of the stock.
Okay.
It wasn't involved with the company at all. This is when Bill Ackman and Carl Icahn were battling in the media. And Bill Ackman was coming on TV. He was on CNBC. This was late 14, early 15. And he was saying, this company's going to go out of business. It's a fraud. It's, all of these things. And he's basically doing everything in his power to get the stock price down. And the sentiment towards the company, you look at how CNBC was reporting on, the sentiment was so incredibly negative at the time that to me, the narrative that consensus had gone so far, and the stock was so cheap that you couldn't lose by buying the stock.
Right.
And this is another one I sold too soon, but I mean the stock is up fourfold or something since then. And so just paying attention to those narratives, because I was following that whole Carl Icahn, Bill Ackman kind of battle. And when Bill Ackman first came out with his Herbalife thesis, people started really buying into that. And by the time the stock bottomed in early 15, everybody was on Bill Ackman's side. And it turned out, I believe, that Ackman was really just so worried that Icahn was on the other side of the trade, and Bill Stieritz and these guys, he needed to create as much fear in the market as he possibly could so he could buy in his short position. Right. And he did that. And so you saw the narrative, that this like peak pessimism towards the company in that late 14, early 15 time frame. And so, yeah, it is kind of a contrarian, framework, but I think it works on macro and micro levels.
Sure. I mean, before maybe Moritz, you want to jump in, but before you do, I can't help thinking, saying all of those things, do you also have a view about Tesla, which seems to be the other big story about, a big battle going on between the bulls and the bears?
Absolutely. I think it's terrific entertainment. I have no position in Tesla, and I won't take one, because for me, Howard Marks has said, and I think this is one of my favorite investment quotes, is to make money in the markets, you have to have a non-consensus view about value, and you have to be right. And so not only do you have to be contrarian, you have to be correct. And I think, to me, there's so much negative pessimism already built into the Tesla stock price. There's so many very famous short sellers that are in it. It seems to me like all the people I talk to, the consensus is short. And so right. The non-consensus view might actually be long in Tesla. I'm not going to buy the stock for that reason, because I can't back up why it might be cheap. So I don't think there's a contrarian value stand to take in Tesla, and the fact that it's such a crowded short too, is something that I try and avoid.
Sure.
One of our traders went on IB to see if we could short Tesla for the heck of it. We're not going to short it, but it was like almost impossible to short. It's too many shorts as compared to the float, and the interest rate is sky high. So,
yeah, and so to me, I mean, yeah, why would you want to step in front of something like that could potentially be squeezed, so dramatically? To me, from a fundamental standpoint, the company doesn't make money. It probably never will. It's it probably should go out of business. But then again, crazy stuff happens in the markets, and a company like Apple that has $250 million in cash could come in and buy the company because iPhone business is slowing or whatever. That's not something that I'd want to try and mess with.
I have a Tesla, and I was so negative on Tesla as a company, and I couldn't warm up to Elon Musk, and then all of a sudden she buys me this car. And then the company starts, having all this negativity, but I actually love the car. I think it's absolutely wonderful, but I'm not sure about the company long term. So mixed emotions.
Yeah, I think I think that's why people buy the stock, is because they do like the cars. And I think the short sellers don't understand too that people do think, there are a lot of people that think Elon is, a Steve Jobs type of person. Yeah, he might be a jerk, but maybe he's brilliant, and he's built this incredible product, and that people have a lot of affinity for, and I mean it could work out. It could work out. To me, it's I moved here to Bend for one of the reasons. I have a crowd phobia physically, so I have a crowd phobia in the markets too. I don't want to get involved, with anything that's crowded like that, except from maybe the other side of the trade. Like I said, in this case, if the shorts are so crowded, I can't make a justification for getting long, but I'd probably be looking at it from that standpoint, just because of I like to go against the crowd.
Maybe the last comment on Tesla before, Moritz, you jump in, and that is there is, as a little plug, I mean, there is a really, whether you are for and against doesn't really matter, but there is a really good documentary on Tesla on Real Vision that just came out this week. And it's an interesting story, and I'm sure there'll be an interesting continuation of that story. Moritz?
Well, I can only say I'd love to speak about Tesla, but then we have to make it a different podcast, because we'll be on air for 3 hours with all our opinions on that car and Elon Musk and the crowded short side of that thing. But, interesting observer standing on the sidelines and following the stock and all the news around it. It's very entertaining. Now, speaking about the trading, Jesse, I mean, I was just thinking, how can we picture and how can the listeners picture a Jesse Felder day? Are you like 80% of the day trading in front of the screen and 20% writing a report, or is it the other way around? What's your kind of like normal day in the markets like?
Yeah, actually, I do very little trading. My time frame is probably, it's multi-years for stocks that I'm going to own, and maybe I'll find, one or two really good ideas a year. And so 90% of my time is reading. So it's just, reading a variety of different publications and things and books. And then, I do a fair amount of writing too, but I would say it's probably 90% reading. I do look at, charts in terms of trend and momentum and those kinds of things too. But I spend most of my time reading by far.
What are you reading at the moment, Jesse?
I'm reading a couple of things. I'm reading a book called The Guns of August, which is about the lead up to World War I. Which is a fascinating read. It's kind of the scrambling for alliances between, France kind of feeling out if England's going to have their back, and hoping Russia's going to back him up, and Germany feeling out Russia to see if they're really going to back up France after essentially losing to Japan, and where does Italy stand, and is Belgium going to be able to maintain its independence, and all of the kind of dialogue that was going on between those countries. To me, it's interesting. I'm in a book club with a few other guys here in Bend that are all really interesting thinkers and successful business people, and they proposed this because of some of the kind of dynamics they're seeing around the world, and to me, there is a parallel here between, I think, what was going on then, and now this kind of. We're seeing this kind of scrambling for alliances with Huawei at the center. This today it's more of a Cold War, like the Cold War, right? With the Chinese, hacking, government military contractors and trying to steal corporate secrets and these types of things. And it's all kind of happening on a technological level. And, it's interesting to me to see the U.S. reaching out and telling Germany and the U.K., if you guys install Huawei, components, we are going to essentially disown you as an intelligence partner. We're not going to share intelligence with you anymore. And to me, this type of, posturing is actually reminiscent of the lead up to World War I. It's an interesting time we live in.
It certainly is. Moritz, did you want to continue down your thought, or...
Well, no, I think one of the other things that came up, I mean, we're all about, we love the markets and trading and reading. I think that counts for all of us. Is there anything like, another hobby, sports, soccer, tennis, football, anything like that you enjoy?
Yeah, I'm really not very good at all, but I play ice hockey.
Great.
We finally got ice here in Bend a few years ago, and I played roller hockey when I was in college. We had kind of a club team. We'd go play. I was in San Diego. We'd go play USC, UCLA, and kind of travel around the Southern California. When we moved here to Bend in 2000, they were supposed to build an ice rink, and that fell through until, so at 15 years I had no ice, but the last 4 or 5 we've had ice, and it's been a lot of fun to go do that. I also play a little golf and try and do a little fishing here and there, but Bend is a beautiful place. I hesitate to talk about it too much because the town's growing a little too fast for my liking, but we have golf and the rivers are gorgeous here. Mount Bachelor is 20 minutes away for skiing and snowboarding. So, it's kind of an outdoor haven.
Sounds pretty nice. You mentioned you read a lot. And I've heard you talk also and refer to in your writing, which I follow with great joy, about Warren Buffett. And of course, you quoted Charlie Munger earlier on. When you follow someone like Munger and Buffett, what are the interesting things or the important takeaways that you've picked up kind of recently in terms of what they're doing? And are you seeing anything that kind of supports this theory about maybe a shift that might be coming down the line?
I think probably the most important shift, Buffett wrote about this 20 years ago. The most important shift that investors are ignoring today is the fact that if most people rely on a price to earnings ratio to value a company, and that doesn't factor in the amount of debt the company has on the balance sheet, and corporations have taken on a ton of debt. So I prefer something like enterprise value. But when you use a simple price to earnings ratio, you are making an assumption that today's profit margins will last indefinitely. Because if profit margins go down, the PE is going to go up. And profit margins today are at their highest levels in history. Whoever you want to take, Jeremy Grantham, Buffett, they've all said that, competition is alive and well in the markets. And that means profit margins are mean reverting. They'll go back to a historical level. Well, if profit margins mean reverted today and went back to a more normal historical level, it would put basically instead of a 20 PE on the market, it'd be closer to 40 today, which is higher than it was in the dot-com mania. And so Buffett wrote about this in '99 when profit margins first got pretty high, and he said, to believe that they're going to remain this high, you kind of have to be crazy. And even if they did, it would result in these political problems that would resolve profit margins eventually. And so he was wrong in that profit margins have remained high since 2000, actually gone higher than they were back then. But what he was right about was that now we're starting to see these political problems that are directly targeting corporate profit margins. So you have, Bernie Sanders, talking about let's regulate buybacks and tie them to employee compensation. In all sorts, a rethinking of the antitrust framework. So why have profit margins remained so high? Part of it is this labor supply dynamic, but part of it too is that our antitrust changed about 25 years ago, where we came up with this consumer harm standard. If companies aren't harming consumers, then they can do whatever they want. And I think we're seeing a huge shift now back towards what does anti-competitive behavior look like? And really, we should start prosecuting these companies for anti-competitive behavior. So if you're doing things to put your competitors, to limit your competitors' ability to compete with you, that would be the new standard. And so, I think we're seeing a lot of these political problems. This rise of populism is directly tied to this fact that labor's share of corporate income has gone way down and corporate profit margins have remained way high. So investors today saying, well, stocks are not that expensive, are making that embedded assumption that profit margins will remain high indefinitely, which I think is probably heroically optimistic. Profit margins over the next 10 years are going to revert back to normal, and it's going to make stock prices today look extremely expensive, which they are on those measures like the Buffett yardstick, which take profit margins out of the equation, that are more of kind of a price to sales measure. And so that's kind of one of the things I've been focused on in terms of, that Buffett, learnings from him over the past few years.
No, absolutely, very interesting. Yeah, another thing I just wanted to ask and pick up on. I heard you all earlier mention Paul Tudor Jones, and how he, from time to time. I'm not entirely sure how often he does it, but I've seen these charts where they do overlays of, the 1929 crash, and that was part of how he predicted the 1987 crash, et cetera, et cetera. I mean, I do, to some extent, believe that markets tend to repeat themselves, et cetera, et cetera. But I mean, do you also spend a lot of time trying to fit past patterns onto current situations? And how do you know when not to rely on it and when to rely on it?
Yeah, I do really think price analogs are very interesting form of analysis, something that I've used for the past, several years. I've been kind of studying. And, obviously sometimes they work, sometimes they don't. I have found that the ones that work best are the ones that have also a kind of narrative analog at the same time. So it was 3-4 years ago, Ray Dalio proposed this 1937 analog, which is one that I've paid close attention to because the narrative analog is very, very close to what we've seen today. You had the 1929 crash, you had the Fed come out and print a bunch of money, you have deleveraging and a big boom in asset prices, and then you have a new Fed tightening cycle. And so when you actually look at that Fed tightening cycle back in 1937, it's very, very similar to the tightening cycle we've seen by the Fed today in a post-financial crisis boom. And then the price analog is about, on a 1 year and 3 year time frame, has about a 98% correlation in terms of price. And so to me, that's just very interesting that the underlying fundamental monetary dynamics are very similar, and so is the price is behaving very similar as well. And so also, I'll use it in terms of, like if I do think the market is in a topping process, let's see, what did the late 2000, early 2001 market look like? And also, what did the late 2007, early 2008 market look like? And is this rally consistent with the bear market rally from those prior examples? And this rally, to be honest with you, has been stronger than most bear market rallies early in a bear market. You have some bear market rallies later in a bear market where, this is pretty typical. Right. But, so I do think price analogs shouldn't be used obviously in isolation, but they can help, in the context of an overall thesis.
Yeah. Jerry, Moritz, what are your thoughts at this stage?
I think I might be out of thoughts.
Oh, wow.
I think I might be out of thoughts.
Well, I mean, before we completely wrap up, I would like just to, I know I asked you earlier about what you're reading right now, but just in general, I mean, to our listeners coming from a very experienced investor like yourself, what are some of the general things that you would recommend? Maybe books, podcasts, or something where you say, yeah, those are good sources of common sense information or something like that.
Yeah, I'm a huge fan of this new podcasting platform. I guess it's not so new, but I think it's fantastic in that it gives everybody a voice and it gives me the chance to talk to guys, like you, who are experts in trend following, which is something that's very interesting to me. It's why I started my podcast, so I could go interview people and learn from them. And it's also a format in which, we can have a long discussion like this and not feel like you're going on TV and they're trying to just suck a couple of sound bites out of you. It's a worthwhile discussion. And so I'm a huge fan of this podcasting platform, but also, I mean, Reminiscence of a Stock Operator, one of my favorite books that I go back and read maybe once a year. I think Market Wizards, the Market Wizards series is terrific. My personal feeling about, for individual investors and kind of what I tell people is, the best thing you can do is go and learn about as many different disciplines as you possibly can from those people who are the experts in those disciplines, and then try and adapt into your own personal framework those that you find valuable, because you're going to find things that make sense to you and suit your unique personality and values, and you're going to find things that that just don't suit you. And so trying to implement an investment framework that doesn't suit your personality and values, that's going to end in failure. And so I think, being able to, just be curious about a lot of these things. And that's who I am. I'm just endlessly curious about a lot of these different ways people, use to make money in the markets, and how can I adapt those into my framework. I think, podcasting and some of these books are a great launching off point for people to do that.
Sure, absolutely. Jerry Moritz, while I just run through where the CTA indices finished the month, so if you have any further thoughts, let me know. But let me just say to the listeners that, of course, as I said, end of the week, but also end of the month and end of the quarter. So the Beep Top 50 Index, although these numbers are as of Thursday, and so there might have been small changes on Friday, perhaps even to the positive, but Beep Top 50 Index up 2.67% for the month of March, up 1.39 for the year now. SocGen CTA Index up 3.12%, now also positive 1.6% for the year. The SocGen Trend Index, not surprising, a strong month, up 5.22% and up 2.65 for the year. Short-term Traders Index did have a positive month, 1.09, but still down for the year, 1.66. And the Bridge Alternative Index, also a strong month, up 5.23%, up 0.68%. Jerry Moritz, last chance for questions for Jesse. Anything that you want to bring up before we wrap up?
No more questions for me, but I must say I really enjoyed that, Jesse. Had a great time. Great speaking with you, and I think that's a great podcast. Thank you.
Yeah, same here. It was really fun. I'm really happy that you're encouraging us to keep with our trend following.
Well, absolutely. Honestly, guys, I was really flattered to be invited. It's an honor to be able to do this with you guys, and I'm a huge fan of what you do. So thank you very much.
Jesse, thanks so much for spending your Saturday morning with us. We really appreciate it, as I'm sure all our listeners do. We are back with our usual format next week, so keep your questions coming by sending them to info@toptradersunplugged.com or send us a tweet. And of course, make sure to subscribe to the Top Traders Unplugged podcast to be sure to get all the new episodes directly when or where you listen to your podcast. And of course, make sure you subscribe to Jesse's newsletter called the Felder Report and his podcast called Super Investors. From Jerry Moritz and me, thank you so much for listening, and we look forward to being back with you on the next episode of The Systematic Investor. And in the meantime, have a great week.
Thanks for listening to the Systematic Investor podcast series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com, and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us, and we'll see you on the next episode of The Systematic Investor.